Now, a question from me to you. Do you know the right time to trade? That is exactly what you will learn in this video. So in the 9th video of the MMC series, we are going to go over time. Now, why is the time that we trade even important? Because when we take a look again at the previous videos, what we've talked about, breaking down those order flow lags, and we have the flood, the odd, and the lot sitting right there, then if we want to continue lower or continue higher from an order flow lag, that will be a lot higher probability if time is also supporting the ID. When you combine time with the right price action, that's when it's the highest probability. That's when you get the best trade IDs. Now, when I was learning about time, it was presented as a very mysterious topic, very vague and very cryptic. So I want to first break down what is time? What do we actually mean with it? Time is volatility. So what is volatility? Well, volatility is how much and how fast price moves. Then when we refer to time, we refer to a specific time where the volatility will be increased. So where we will have a lot of volatility in the market. Now, when there's a lot of volatility in the market, you will see price action like this. Fair value gaps being created, being respected, and we continue lower. When there's a lack of volatility, you will see that price struggles to continue higher or continue lower, more so creating a consolidation. So volatility for any type of trader is extremely valuable because when we have volatility, that means that price will actually make a move somewhere. So volatility is at the basis of every trader. Every trader needs some kind of volatility. Because let's say if you place an entry right here, the volatility allows price to actually move higher or move lower towards our stop loss. When there's no volatility, there's also no trade ID and we don't move anywhere. As I like to call it, it is the energy of the market. For you to be able to move, you also need energy. So you need, for example, an energy bar. You can eat it and you get energy so you can move a lot. Now, the market doesn't eat energy bars, but the way the market gets energy is through the following methods. When we talk about getting that energy, getting that volatility, and what type of time we have, then we talk about the following two. Higher time frame time. This refers to the economic calendar, so news events. When we have a news event, there will be an increased amount of volatility. Now, this is also the case for lower time frame time. Lower time frame time refers to sessions or kill zones. Higher time frame time is what we're going to focus on in this video. What makes a higher time frame actually volatile? What makes the higher time frame move? Lower time frame time is what we're going to focus on in the entry video. And that will be focused on what makes the lower time frame move. So what is that higher time frame time and why is it important? Well, higher time frame time is important to know if a PD array on the higher time frame will actually hold. So do we have enough volatility when we come into a higher time frame PD array to then continue higher from it or continue lower from it? To give you an example, we want this to happen right here with our fair value gaps. We want to trade back into it and that there's enough volatility to make a significant move lower right there. We do not want something like this to happen, where we have a sting into it and then afterwards we just simply have a consolidation. And this is what that higher time frame time will help us with. Now, I've also written down right there, it's a smoke screen. And what am I referring to right there? Now, the reason why I call these news events a smoke screen is simply because of the fact that short term, it's nothing more than volatility coming into the market for price action, the technical analysis that we currently have, to actually play out. So what you'll notice is that oftentimes the news events actually follow along with the technical analysis that you also have. Now, does that mean that the technical analysis determines what is going to happen with a currency long term? No, of course not. Long term, you will see the effects from a news event, and of course, then the news actually determines if we're going to go higher or lower long term. Now, when we talk about higher time frame time, we are talking about the economic calendar again. This is an example of the economic calendar. And what you're seeing here is different news events for different currencies. Those news events are, of course, important for that currencies, for the state of the currency. So those news events, they bring in volatility. So what we mentioned, these are the energy bars for the market. They bringing that energy. Now, the economic calendar that I use is forexfactory.com. This is the website of forexfactory.com. And before we move on, I want to show you how I have filtered the economic calendar news events as well. I am not affiliated or anything with forexfactory.com, just so you know. On forexfactory.com, if you go to the calendar right there, in the top right, you will see that you can filter things. When you click on that, these are the settings that I have. So the only one that I've turned off is the yellow folder right there, and also the CNY currency. Then I apply the filter. One more important thing, in the top right as well, under the time, I always have my time, whether it's in TradingView, whether it's in Forex Factory, when I refer to any time, it is Eastern time, New York local time. Then the economic calendar for this week that we currently have will look something like this. So how can we then use that economic calendar? Well, the first one is which currency can be volatile. If you are going to be a trader that focuses really on the higher time frame and focuses on multiple pairs, multiple instruments, then you are going to become something that we call a filtering process trader. That means that you are always looking to find the highest probability price action based on the higher time frame. So you go over multiple pairs and you see which one is the highest probability. That is where the economic calendar also comes in, because currencies that have more volatility are also going to be higher probability. Because again, the more volatile, the more likely it is actually going to move somewhere. Otherwise, it's just going to stand still and be a consolidation. So looking at the economic calendar, we can also see which currencies are going to be volatile throughout the week. For example, euro right there. For example, Australian dollar as well. Then we have a lot of news events for the rest of the week as well. Now, one that we don't have is New Zealand dollar. So a currency like the New Zealand dollar is not going to be very interesting to trade for this week because it has less volatility than, for example, something like Canadian dollar, which has a red folder news event right there. Now, that is how we can get to a high probability instrument. And then we want to combine that with the understanding that we have of PD rays. So in the previous videos, we have gone over every narrative area. So what we can continue higher from or continue lower from. When we trade back into one of those PD rays in an order flow lag. And we also have time agreeing with the ID, that means there's enough volatility to actually continue lower from a bearish fair value gap, for example. When we understand that the higher time frame is high probability and will make a move, then the lower time frame will be a lot easier to navigate when we get into entries. Now, we'll go over multiple examples on how to combine that time with those narrative areas as well. But before we do that, we also need to understand number 3. And that is that we always, and I mean always, need to respect risk management. Now, we're going to have a dedicated slide towards respecting risk management as well and why it's so important. But I need you to understand that I'm not here to encourage news trading and gambling going full margin on, for example, something like NFP. If you are planning to do that, then you are ignoring the one factor that allows you to be a trader, which is risk management. So you might as well go to the casino and put everything on red. But first of all, we need to go over how we can combine it with a higher time frame PD ray. Now let's assume right here that we are looking at the daily time frame. And the daily time frame looks something like the following. We have a perfect fair value gap right there that we can trade back into to then continue higher. But what happens in these daily candles right there? Why is one daily candle so extremely volatile? So why is one candle moving a lot and the other candle is a consolidation right there? Well, that could be something like this, where on Monday we have no news. So for example, this third candle of that fair value gap that creates a consolidation, we might not have any volatility. When there's no news for that Monday, we can expect, okay, potentially consolidation on Monday. By Tuesday, the fair value gap is now created. If we then sting back into that fair value gap, and we also have news supporting the ID on Tuesday, that Tuesday can then continue higher from the fair value gap. So to give you an example here on Australian dollar CHF, we have this daily fair value gap right there. Now the first day that stings and that trades back into the fair value gap is this candle. This candle is a Monday, the 29th of July. That candle is not a big rejection, as in it's not creating a very aggressive down candle to then continue lower. But the second candle right there is an extremely aggressive candle to continue lower. And the candles afterwards as well. So what happens on that Tuesday, the 30th of July? Well, if we take a look at the economic calendar, we see on Monday, there's no news. On Tuesday, we have Australian dollar CPI right there. That means that for the Australian dollar, there will be a lot of volatility. So something like Australian dollar CHF, since it has Australian dollar in the ticker name, it will be more volatile. Now, if we go over the next example, and let's say we have a breakaway gap, when are we more likely to create a breakaway gap? And if you understand the previous example, then you'll probably also understand this, because let's say we have Monday news and Tuesday news as well, then it's a lot more likely that Monday is volatile, so Monday can already continue higher as well, and Tuesday can also already continue higher, where we don't get that perfect fair value gap because we don't get a consolidation. Now, this is then what we can get very creative with, and also what will help us understand how the week will actually form. So what is often referred to as a weekly profile, how we can understand which weekly profile we will most likely have as well. Now, if we get very creative with this, and then we understand also the next example right here, because what happens here? We have this fair value area, the fair value gap, which we can continue higher from. The first day right there is not a rejection. This is again trading off that last line of defense, like we've mentioned in the previous videos. We get the previous candle low sweep to then continue higher. Why do we not reject on that first day? Well, this could look something like this. Monday, no news, creates a consolidation for that fair value gap right there, the third candle. Tuesday, no news. So it has a rejection lower, but it does not have enough volatility to actually make the push higher. So what happens? Wednesday is where we do have news. We sweep the previous candle low to then continue higher. Now, once you start understanding this, you will start understanding when to trade. And knowing when to trade is so extremely valuable. And not only because it sounds cool, it sounds like you're a professional, it's also valuable for your psychology. Can you imagine staring at the chart all day? If you have done that in the past, and from my experience, you are going to be absolutely destroyed at the end of the day. The more chart time you are going to have, the more errors you are also going to make in your trading. You're going to overtrade, you're going to take trades that you should not be taking. And funny thing, if we look at it from this perspective, we have been talking about liquidity in the previous video. And that liquidity in the market is that for every buyer, there needs to be a seller. For every seller, there needs to be a buyer. Well, what is the reason why 90% of the traders do not fail? Is it because there's some kind of magic formula out there that you can simply follow and you will be profitable? Or is it also because people tend to struggle with their psychology? They tend to overtrade. They tend to revenge trade. Again, taking trades they should not be taking. So what are the odds when you click buy and on the other side of your trade, there's someone selling to you who's taking a trade they should not be taking because they are struggling with their psychology? And why is that then important? Because that understanding leads to that you are out competing other people based on how long you can keep your psychology intact. How can you keep your psychology intact? Meaning, how can you not mess up in your psychology? That is by limiting your chart time. If you are away from the charts, can you realistically do anything? No. So by limiting your chart time, you will also have less psychology errors. You will be more fresh. And when you do look at the chart, you will be more focused. You will have more emotional control. So someone that looks at the chart every single day, 8 hours a day, 24/5, that person is going to have a lot more psychology struggles than someone that only looks at the chart when they know they should be looking at the chart. So I know I only need to look at the chart on a Tuesday and a Thursday this week. In that short period of time, that Tuesday and the Thursday, you're a lot less likely to mess up in your psychology. So you are outcompeting someone else just purely by keeping your psychology in check. This is why the technicals in your technical analysis should align with your psychology. You can't expect to have 1,000 things on your chart and then just say, well, now I need to work on my psychology. No, working on your psychology starts with working on your technical analysis. When they set you up for success, they give you an assist to succeed in your psychology, that's exactly when you will reach profitability as well. And that's what we're doing. So to give you another example right here. Here we have a failure to reject off that fair value gap right there, or we have somewhat of a rejection, but not a new fair value gap to continue higher from. Instead, we sweep the low right there and then continue higher. Now, what could this be? This could be something like Monday, no news, Tuesday, no news, Wednesday, no news, Thursday, no news, And then Friday news, where we consolidate throughout the week. Friday could be something like NFP, which is always on the first Friday of the month. When that happens, we tend to consolidate before NFP, and then we can look to continue higher or continue lower, because that's where the real volatility comes into the market. This is how you combine it with a higher time frame PD ray. Now, to understand it fully, when we talk about these economic calendar events right here, these news events bring in volatility for that particular day. So something that you can do is go to a website where it shows the average movement of price for any particular day. And if you look at the days where we have the most movement, that is also the days where we have the most news events. When we know this, that means that before the news release, so let's say right here we have core retail sales for the US dollar red folder news. That means that that day, that Tuesday, July 16th, will already be more volatile for the US dollar. And that is the important part, because that allows us to, either before the news release or after the news release, execute a trade ID. So if on that day we have a sting into a fair value gap, we wait for our entry confirmation, and we know that we already have more volatile, we can simply take that trade. But this does not apply to the following 3 news events. That is always where we want to wait until after the news release has already happened. And that is the following. This is about respecting risk management, where we will touch on the big 3 news events. And the big 3 news events are the following. NFP right there, which will show up as non-farm employment change. Not the ADP, non-farm employment change, which is on a Wednesday. It's the one on the Friday, non-farm employment change, NFP, simply known as non-farm payrolls. The second one is US dollar FOMC statement, not FOMC meeting, FOMC statement. Then the third one is CPI for the US dollar, which is consumer price index. Now, why are these big 3 news events the one that we want to watch out for? There's a following rule set. When we have these big 3 news events, the day before will also be less volatile. So not more volatile, less volatile. Because there's a higher probability that the day before this news release, so if NFP is on a Friday, on a Thursday, we will see a consolidation. And on Friday for NFP, before we have the news release at 8:30 a.m. New York local time, we will also most likely see a consolidation until after the news release. That's when the volatility is in the market. The reason for that is because these big 3 bring in so much volatility that the market actually consolidates beforehand and then after explodes to one side or sweeps one side and then the other side. Now, the reason why these are dangerous and we do not want to trade them at the exact moment of the news release, so only after, give it a few minutes, is because of slippage. And slippage looks like the following. If you are in a trade right there, and let's say you are in a 1-minute time frame trade, you have a stop loss above the recent 1-minute swing high, or you are about to execute a trade at that moment in time, when we have NFP release or one of those news releases right there. Then if you have your stop loss in place, you are not going to get filled at the exact stop loss placement. Unless you're trading in demo and not in live conditions, then you are not going to get filled at the exact stop loss order right there. If we are shorting the market and we have our stop loss above the recent swing high, we are not going to get filled at that exact stop loss. We might get filled a little bit higher. Now, with the amount of volatility that comes in during one of these news releases, we might get filled a lot higher. And that means that we won't be risking 1%, no, 10% might be on the line at that moment in time. So if you're trying to make 2% with 10% risk because of slippage, then you have a negative RR and you are disrespecting the fundamental thing that allows you to be a trader, risk management. And if there's no risk management involved, then it's nothing better than simply gambling. And if you ever want to be a long-term successful trader, then this gambling is not the way to go. Now, one other rule about the big 3 news events, if you have NFP on a Friday, for example, and on Wednesday you have FOMC, that means that you have 2 big 3 news events in one singular week. That also means that the first big 3 news event in that week will not bring in the real volatility. Yes, it will bring in volatility, for example, that Wednesday with FOMC, but after it's most likely to still consolidate And then NFP, the last big 3 news event for that week, will bring in the real volatility, the real direction in the market as well. Then there's one more thing to do, and this is for your sake, start doing a case study. The case study for this video is study which days a PD array holds. So where we continue lower off a bearish fair value gap, for example. And if there was any news event supporting the ID. So if higher time frame time was supporting the ID. And then we can move on to the context videos. All right, perfect. Thank you.